Hey everybody, welcome to Jazz After Dark, my favorite time of night with you guys. Hope you're having a good night there. Still working on the Bondstone here, Kentucky bourbon. This class tonight will not be for those of you that are looking for a quick fix. This will be extremely educational, and I really want to help you see that there are multiple levels of thinking. There's the retail level, of course there's the novice level, and then there's that professional level where they seem to gather the right data and figure out what to do. Now, this stems from my background. I'm a former fund manager, so I used to manage investments for Chinese investors that invested here in the States, and we would build portfolios and stuff, which is why you see here at Jazz Wealth, we have our own portfolios. That's our background. That's what we do. So I want to take you through a little bit more of a detailed look and use the current market as a way to make it kind of relevant, right? So we'll go through the analysis and then we'll explain kind of how we do things. But first, grab your drink. Hope you're ready. Ooh, smells so good. I've been drinking lemon water all day. All day. So there. I've got like 2 gallons of lemon water, like water with a lemon in it. So killing it here. Okay. So I'm going to say something, and then I will backtrack and we'll explain it. The S&P at this point, and today is the, 25th? So the S&P, this is 26th. So the S&P at this point has outperformed the fund flows by 7%. What does that mean? So instead of guessing where the market's going to go, you can use data and actually look back through money moving in and out of the market in various ways to determine if the market is moving higher with less participation, or a lot less participation in this case. And previously, I've shared this with you by doing something like this. I would share this chart and basically show you that in the gray here, we have money moving into money market funds. And some of that was bank deposits that have since figured out there's better ways to make money. But we could tell that some of it was coming out of the stock market from those people who had money in the market during the years where the S&P was the highest yielding product available. So if you're retired in 2018, you couldn't use a bond. There was no interest to be made. You couldn't use dividend funds. You couldn't use really anything, money market, CDs, things like that. You had to use the S&P. And at one point, I remember the yield was 1.89%. People were saying that's the best place to get it. That's a dangerous place to get it with that safe money. Well, now you've got lots of choices, right? So you can go to a money market fund, a CD, a bond. You can do things that are essentially no risk, right? In the background there, the dark blue, we can see that, and I've shared this before, so this is not new, but you can see that this is the fund, the flows into equity ETFs, your SPY and VOO and XLK and whatever it is. This is the money going into it. Well, that's starting to dwindle out a little bit here. So it shows that money is starting to leave, go to money market funds and go elsewhere. And it's like, that's a trouble one there. So what we want to do is build a model that looks at all flows, right? All money coming and going from everywhere. The retail investors, the institutional investors, or the pros, the wealth managers, the hedge funds out there. We want to see what's going on. So we can find that if we model flows, man, that was good. If we model flows against the market, we can actually see whether the market is priced high, priced too low, or what they call priced to perfection there. Now, typically what we find is that declining money flows leads to declining S&P prices, right? If less money is participating, then it's one of those scenarios where maybe the market's going up because NVIDIA had such a great day, and its sheer power of that move, a 25% move in one day, is enough to move a market cap weighted index, right? Which is the more valuable you are, the more pull you have on an index there. Now, if you say, oh, I know how to find fund flows, I will do the same. I'll share some of the data with you here, but most novices, retail traders and investors, they do a couple things sort of plain Jane. they will assume that cash is a fixed commodity. And we know from COVID that it's not. Cash can just present itself out of thin air. So the first thing we do is we're going to make a model based on the actual supply of money. So if there's more money supply, we're not going to pretend that there's not. We're going to incorporate that. It's very simple. The more dollars that are going into the market, the better. Well, if there are more available dollars, then we need to account for that as well. Now, when we build this model, we don't want to just look at fund flows. That's actually research you can get, pretty public and everything. The problem is it's a lagging report, meaning the data is already old when it comes out. And so modeling fund flows against the S&P would be considered a lagging indicator. It's okay, but it's not great. We would have to adjust the way we plot things to account for the delay in the data. And there would always be a little a week and a half period where the market's moving, but we don't have any available data. So our chart would look a little funny, it simply put there. It's a big flaw that I see where I see other YouTubers out there and they will plot the fund flows against the market, and it's never quite right. And they try to shape it and make it look right. One lady in particular does it. We can't do that. We need real-time data. We make decisions based on our funds here with real-time data. So we've got to get that. Now, we have to use some proxies to get that data. So we're going to be a little bit tricky here about how we do it. The first thing we want to do is we want to use ETF data, right? So we're going to use corporate bond ETFs, retail ETFs. That is data that we can get up to date and accurately, and we can measure liquidity. Why would we want to measure liquidity? Aren't a lot of ETFs highly liquid? Yes, when I say liquidity, I want to measure the available liquidity. If there is an increase in the available liquidity, in particular in the options market, because most hedge funds don't use the ETFs, they use ETF options. I've done a video on that. And so it's better for them to do it. It's more liquid for them to do it. And it's, of course, more advantageous probability-wise for them to do it. So we want to use that data, and we can get it real accurately. If there's an increase in available liquidity, then it means there's less participation. It's not the other way around. If there's less liquidity, it means it's being soaked up. There's a lot of available participation there. The next thing we want to pull into this model is we want to look at prime brokerage data. Right? That's going to be accurate and up to the second. Now, this is more proprietary. You'd have to pay for this and stuff, but this would be the data we get from hedge funds. Hedge funds don't do like we do and just go out and buy shares of NVIDIA or sell them because it had such a great day or whatever. They use many different avenues to participate. And it could be just simply using options through a third party. It could be negotiating a trade with someone else that is on the phone that they actually want to do business with. It could be what's known as a block trade, where, for example, a hedge fund wants to do a really large position in Apple. Well, the prime brokerage firm would actually say, I know a guy at JP Morgan who's trying to unload from his mutual fund a lot of Apple stock or options, whatever they're going to do. And they'll pair that trade up. So it never really comes to the market. It kind of goes around it. So we can track that. We're tracking stocks, futures, returns, swaps, calls on stocks. We can track even selling puts. We can track index calls, structured notes. You can do all kinds of things to determine the flow of money that ultimately will make its way to the market. Because a hedge fund has a position, they will unload it, and unsuspectingly, all of us will buy it or something, whether it's bad or good. I'm not saying they're always right. And so the ETFs themselves, like I shared with you, so they are a real indicator, a driver of market strength there. But we now know that that has really slowed noticeably. And there's a famous quote, I wrote it down because I forget it there, that investors changing their economic and market beliefs change decisions, but actual position changes, money flows, drive price. So we want to see the actual decision changes. You might feel like Biden this or that, and Janet Yellen this or that, and the Fed's got it wrong and everything. Your belief is that, but until you make a decision, I don't really care, right? It doesn't help me make a decision. Whereas you, and tell me if I'm wrong, you will watch TV, read a headline, see some blog post or whatever, not really read the whole thing, but it tells you doom and gloom. So your sentiment is changing, but until you take action, it doesn't mean anything as far as market prices go. So it's a little bit, so far, I hope I haven't lost you, right? Oh, if so, drink up, right? It's a little bit deep tonight, I told you. I love doing the basic stuff, but every now and then there's something obvious, and I'm like, if I can word it just right, then we'll go through that. So all that to say, let's build a model where we're going to plot the actual movement of the S&P, and this is an obscene amount of data. So our data, we've been around for now 6 years, so we don't pay for 50 years worth of data. We go back 8 years because we're taking action inside of the current and whatever's happened. So we don't need 30 years, 50 years of data to try to prove a point. We want current data. So all of that to say, we'll build a model of all of that included, and we're going to weight based on volume. So those who move the most amount of liquidity in and out of the market, we're going to count them first. We're not going to make a model based on retail ETF flow because those dollars are very minuscule compared to what the institutions are doing, right? And real quick, what I mean by that is if you buy an ETF, okay, you bought an ETF, right? If you work with a wealth manager or someone like us and we buy something, it's actually treated differently in terms of reporting. So, I mean, the retail as in you deciding to buy the SMH or something, right? That's your decision. It's a retail transaction that occurs through, Schwab or Robinhood or whatever it is. All right, so here's what we find. Nope, that's not what we find. This is what we find. And I didn't even change the title, so we can just get rid of that. Don't even bother. I should just get rid of that altogether. So in blue, we build out the model, which includes all of everything we talked about: the prime brokerage activity, the hedge fund activity, mutual fund outflows, current and available CFTC data, and of course the spreads we talked about, and liquidity that we mentioned, which falls into futures, futures options, index, and index options. So what we can find is that it really is a long way of proving a pretty simple point. In light blue is the S&P return. In dark blue, you could essentially say this is the S&P if it were to focus on the model of liquidity and everything we just talked about. So what we find is that when there is, in short, I'll say, an increase in money flow, there is an increase in prices. If there is a decrease in money flow, you run into a decrease in pricing. And so now instead of being a lagging indicator, we get a current indicator or a forward-looking indicator. Well, what we have now is what I mentioned at the very, very beginning. In light blue, the S&P is outpacing its model, essentially, its ability to keep up with the cash that's coming into the market. So this lift right here, we can now, just because we are looking at it and something that we do on the closing beat, we can say that that move in the S&P is not driven by dollars, new buying coming into the market. It's being driven by the sort of weakness of the S&P, which is that those who have a higher valuation drive more of the decisions. So for example, yesterday with AMD and Nvidia, great moves. Well, Nvidia and Microsoft, those two stocks yesterday accounted for the entire day's move in the S&P. In other words, if those two stocks never existed in life, the S&P would have had a very minor up day due to everything else. So we know that we can use two things now. We can go do that analysis and see that, yes, those are in fact driving the recent price increases in the market. That's easy to see. We can also see that money is not driving it. New dollars are not driving it. And historically, when there's a spread between current and available cash, liquidity, swap spreads, whatever, coming into the market, there's a less participation. Historically, that leads to lower pricing. Less participation, lower pricing. Right? Less participation, lower pricing. And instead of hoping that this happens, we can see that it happens. There's not a long period of time we will need to wait. And another last point, why do so many analysts have a 4,000 to 4,100 price target on the S&P. What, are they stupid? Are these guys dumb? They're fun to pick on, right? Because they'll, the one guy said Nvidia's a buy yesterday. Well, he doesn't mean buy it now. He means that it's definitely something you want to hold, right? I was not saying buy it then. These guys use data just like this, and I would venture to guess way more complex than anything my little brain can put together. However, this is good enough for me to make a decision. What's the decision? Well, we have available cash in our funds and have had some for quite a bit of time. In fact, we didn't even suffer last year's declines compared to someone that was in the S&P. So now we say, we can't hold this cash forever. We need to put it to work. Eric bugs me every day about this. So I go, okay, Eric, give me a good reason. A client was asking, and I'm like, well, tell that client to give you a good reason. We're supposed to be the stewards of their finances and their money. Give us a reason. I keep sharing data with you like this and doing that extra legwork on the closing beat and on these shows and everything to try to show to you that the big institutional, the big guys, JP Morgan, Bank of America, all their analysts that eventually drive decisions that their wealth managers and their traders make, that then those people have to go report to the retail end client and say, this is why we're doing what we're doing. All of those people have the same data that says, there's no way the S&P should be this high. It is only this high because of a couple stocks. So that's why analysts have year-end price targets from 4,000 to 4,100, the ones that are successful anyways. Of course, there's always an oddball analyst out there on both sides. But hopefully, I didn't scare you. And hopefully you now know that there is another level to thinking through investing. How many, back in the last thing, and I'll get out of your way. How many of you remember in the great starting beginning, I'll say late 90s by the time the technology caught up, but you remember the trading days where people moved from trading on the tape, in other words, just watching price and trading that way, to using indicators like your stochastics, your MACDs, your various oscillators and indicators, right? All the ones that have popped up since there, your Bollinger Bands and everything that's been around now forever, but was brand new back then. Well, if that was what everybody was using, you wanted the next level. You wanted to think of that in a deeper way. Well, now data drives everything. So we want to know what's the best data to drive a decision we're trying to make. Is it perfect? No, I tinker with that model, and I personally want to adjust things, but it could be adjusted and you could find an even larger spread between the markets and the S&P. However, from my background and my training, that's about as close as you can get to using that. Not for a sole decision, but to piece that together with, money's going into money markets. We see it leaving the stock market. We know the debt ceiling thing is an issue there temporarily. We see a slowdown in earnings. We see a slowdown in GDP ever so slightly. We see the possibilities of that slowing down. Oh my God, we've got this big now bucket of things. Are they positive or negative? They're not necessarily negative, but they indicate that the market shouldn't be where it's at. And that doesn't mean you fight that. It means you use the next opportunity of a pullback or something to increase your risk, if it's suitable for you, of course. All right. Did I wear you out here tonight? I hope I did. It was a little bit of a long one, but this is fun for me every now and then to get to stretch the brain out with you guys instead of just talking retirement and basic stuff. So hope you enjoyed. Please let me know if this was way off base, and I'll never do it again. If it was, whatever you think, leave a comment, and I'll also say chances are I probably talked over myself at some point because I get a little excited. If I missaid anything, of course, you can point me out on it. I would like that to be clear. Enjoy. We will see you next week then, huh? Yep.